Vetri Subramaniam is Chief Investment Officer at UTI Asset Management Company, and he's joining us. Vetri, good morning. Great to have you with us here. Thanks very much. A lot has been thrown at the market over the last couple of years, local and global, more global than local, and we are at new highs, practically at new highs, 100, 200 points away. What's the trajectory? Is it looking all good? Just wanted to also get a quick word in on earnings that you and your analysts have been sort of looking at. So far this earnings season seemed a little underwhelming to me. Your sense?
Yeah, hi Prashant, good to be here. You're right. I think, the earnings have not really particularly surprised on the upside. But having said that, I still think, the numbers for March 24 estimates pretty much look like we should be on track. Company levels, there could be surprises, but I think that's minor detail. The bigger picture is, remember that for the current year, it's actually more about, when I say current year, I mean March 24, it's more about margin-led earnings growth than top-line-led earnings growth. And I think the feature about which we need to get more confidence as we enter the earnings and we look forward to the FY25 earnings is, are you going to see volume numbers moving up? Because I think the best of the margin expansion is now behind us, and earnings in 25 will have to be more volume-led. So I think that's the big premise. As far as global and local is concerned, I would say, the global picture is sort of a little bit more tricky now. At the start of the year, people were thinking about 5 to 6 rate cuts by the Fed, and now people are talking about the possibility that the next move by the Fed might be up rather than down. So I think that's a very big shift in, the kind of expectations for interest rate policy. It hasn't held back equity markets so far, but I'd keep my eye on it.
Okay, well, just look at Tech Mahindra. By the way, it's just zooming right now. I don't think too many people would have expected this kind of an up move on Tech Mahindra. But I think the fact that the new CEO, Mr. Mohit Joshi, laid out his FY27 strategy, he spoke about the top line growth being above the peer average and a 15% EBIT margin. Just that confidence from the management is something that has resulted in a big up move in the stock as well. Vetri, I wanted your thoughts on what's happening in the IT space, right? It's interesting because the space is sort of coming back now from the underperformance that it has seen in the last 1 to 2 years. Is this a good time to be putting some money to work here?
Good question, Sonia. Look, I think the news flow, when you look at it in terms of what's happening from the companies, in terms of hiring, when you hear their commentary, in terms of what visibility they have for growth, very interesting comment by the TCS CEO on the front of what is the visibility for FY25, and he was quite muted about it. So I think that's the environment. Having said that, these are some of India's most globally competitive companies. We've seen in the past how they've been able to execute when they have a little bit of a tailwind. So from my perspective, the fact that things are looking slightly difficult doesn't make me negative on them. I'm just willing to be a little bit patient about buying them into weakness, buying them into bad news, because I think eventually they will emerge stronger. And the other reason I say this, Sonia, is just look at the kind of numbers. I'm not talking about the earnings numbers which are coming out of, the big tech companies in the US. But just look at the amount that they are articulating in terms of the capex that big tech will have to carry out in the US. Now, what we've typically seen is that with a little bit of a lag, this tends to create positive momentum, in terms of business flows across the board, and some of it percolates down even to the Indian IT sector. So I would say, hopefully the kind of capex we are seeing in US tech signals better times ahead for the Indian IT sector, and into any kind of weakness or bad news, that's when you get valuations which are more attractive. I'd be pretty happy to look at the IT sector.
All right. Hi, Vetri. Good morning and good to see you in. Nigel on this side. What about the RBI's action? The commentary has been quite stern, and the action as well coming from the RBI on various banks and financial related companies as well. How do you view this, and what would your approach be to banks between private and public sector banks, and also NBFCs? And Vetri, another problem is that if some of these banks are going to be wrapped on the knuckles, then there was some hope maybe post-election we'll see some divestment of banks like IDBI Bank. That gets pushed back a little bit more, right?
Yeah, Nigel, I mean, this is kind of the stock-specific risk. We've typically thought about risk more in terms of how companies will manage their non-performing loans. That's the kind of issue we've worried about more. But I'd say over the last 2.5 years, it's really been more of stock-specific risk arising from regulatory action by the RBI. The only point that I would make, and this cuts across the board, it doesn't matter, private bank, PSU bank, NBFC, housing finance, across the board, they've been acting against multiple players. The only point that I would make is that this is more stock-specific risk, certainly a setback for some of those institutions because it compromises their ability to grow, compromises their ability to manage the growth, businesses that they would like to focus on. They have to sort of readjust, and management time obviously gets pulled into sort of addressing the issues with RBI. So I would say certainly a little bit of a stock-specific problem, but maybe the banks which so far have not been wrapped over their knuckles may actually use that as an opportunity to accelerate. So not something I'm particularly happy about, but my larger call on banks and financial sector would remain that these are some of the best balance sheets that we've seen in the banking sector in many, many years, pretty much, I would say, going back 20 years. As the economy continues to grow, I think there is scope for credit, both to households and to corporates, to accelerate. There is potential for credit growth to happen faster than GDP growth, and therefore, what's not to like about banks in this environment? So, stock-specific setbacks you can handle with diversification across a host of names, but I'd still be quite positive about the banking sector in terms of the potential. But actually, I would say not just outperformance, but absolute returns over a 2-year period.
Right, and that, post-election, the hope is about some of those assets getting divested. That gets pushed back, right?
Well, again, that's stock-specific, Nigel. So, if nothing happens over there in terms of those banks being wrapped on their knuckle-specific institutions, there's no reason it can't happen. But again, that's very special situation, so I have no comment on it.
Vitri, you're also one who tracks some of the global macros carefully. The US 2-year is at about 5% now. Last time it happened, it triggered about a 10% fall in US markets. US is already down about 5 from the highs. You think there is more there?
It is certainly a cause for concern, Prashant, because, two things. One is you've significantly raised the cost of capital. We know there's some excess, savings with households, corporate balance sheets are reasonably good. But this is increasingly going to put stress on the government and the fisc. And there are two things that I would highlight over here. One is, look, the US is continuing to run fiscal deficits at 7%, and it looks like irrespective of what the outcome in the current election is in the US, one party is calling for more spending, the other party is calling for tax cuts. So there's no sign of this fiscal deficit coming down at all. And therefore, I would really worry about the potential that the bond market eventually delivers a scare both to growth as well as to equity markets and to governments, right? That's something we certainly need to worry about. The second point that I would highlight over here, Prashant, is that if you look at the US Treasury, I think they've been playing a slightly dangerous game here. They have been relying on borrowing through Treasury bills very significantly over the last year, year and a half. Maybe because their own assumption was that at some point rates will come back down. But now you'll actually run into a challenge where if rates don't come down, they actually remain higher. The Treasury is going to have to push the button on higher sales of long-dated securities, and that is not good for the bond market at all. So I do worry that the bond market is about to deliver a scare both to equity markets and to US growth. And we know that US monetary policy sends shocks throughout the entire financial system.
As someone I was talking to said, and this is of course obviously in jest, he said that most bond market money managers are also big equity investors. So, they're happy making money in equities.
I mean, it's been a good year, hasn't it?
You lose a little here, but you make a lot there. So it's okay. I mean, let's not upset the apple cart. I don't know, Vetri.
Yeah, actually, Prashant, it's been a pretty good time for risk assets. Commodities have taken off. Gold is doing well. Equities, maybe down 5% from the peak, but it could have been far worse in the US. So I'd say overall risk assets are doing quite well. But, I'd really worry about the fact that at some point the bond market delivers the scare to, everybody else who's full on risk.
Okay, all right. Vetri, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. And of course, we'll chat at length later on. Have a great weekend.